Oil closing up about 4% today, the highest close that we've seen in about a month amid concerns that OPEC Plus may cut supply. And in Europe, Shell's CEO was warning that the ongoing energy crisis could last for more than just this winter. Joining us now to discuss all of this, we want to bring in Pavel Molchanov. He's the director and equity research analyst at Raymond James. Pavel, it's great to see you. So this huge jump that we've seen in the price of crude and now settling today just above $97 a barrel. How quickly do you think we'll get above 100 and how high could we see prices climb?
Well, first to point out, oil price increase is nothing compared to what's happened with natural gas, as you noted, in the European market specifically. Price of oil's up, about 50% since the start of the year. Not nothing, but not huge. Natural gas prices in Europe have more than doubled since the start of the year, and the price of electricity's doubled. So why is this happening, particularly in Europe? Because, of course, this is where Russian natural gas traditionally goes. And Russia, as a matter of deliberate geopolitical blackmail, has cut its supply of gas into the European market by 2/3 since the start of the year. So this includes Germany, Denmark, Netherlands, Finland, Poland. None of this has an effect, or at least direct effect, on natural gas in North America or China, for example. But in Europe, it's a very big deal, and this is a much bigger story than what's happened with oil as a result of the war.
So then, Pavel, as you're talking about gas, then what sort of domino effects then could we see?
Well, domino effect, certainly electricity in Europe, as I mentioned, has doubled since the start of the year. Of course, Europe does not get all of its electricity from gas, but gas is important. And we also need to bear in mind, hydroelectricity this summer has been in very tough situation due to the heat waves. And this is true on both sides of the Atlantic. So you combine the drop in hydro generation with the loss of Russian gas supply, and record heat also means demand for electricity in Europe is at record levels. With all that, even countries that use very little gas or Russian gas, like Norway and France, are seeing very sharp escalation in the price of electricity.
On Wednesday, they've got some maintenance on the Nord Stream. Bills in Britain expected to soar 80% as they head towards what appears to be an energy crisis. There's talk of price caps. Beyond that, what can they do to avert a crisis?
In the short run, the only real solution is demand curtailment. So the EU in August approved a plan to reduce gas usage voluntarily by 15% through the winter. If it cannot be done voluntarily, there will be an emergency brake whereby Brussels can essentially mandate forced demand reductions. Now, I don't want anybody in Europe to think that people will be freezing this winter. It is not that type of situation. In fact, the goal of this policy is to prevent that from happening. So in reality, what will happen is chemical plants, steel mills, they in some cases will need to reduce their operations, heavy industry in particular, but at least individuals and small businesses should have all the energy they need.
Pavel, then what does this mean just in terms of long-term implications from this? If we do see some of these larger factories, larger places having to shut down or curtail the amount of gas that they are using, what does that mean for some of the longer-term effects that this could have on the economy?
Well, the good news is that in the long run, Europe and indeed, every country is undergoing energy transition, which means that, if we have this conversation in 2025, the role of Russian gas in Europe's energy mix will be close to zero. And indeed, the role of fossil fuels overall will be much lower than it is today. So that's, less political leverage for for the Kremlin over the European economy by that point. To get to that point, what does Europe need to do? Build solar farms, build wind farms, including offshore wind, deploy green hydrogen, implement energy efficiency solutions. None of this is rocket science. All of it is simply a matter of spending capital, having the right policies in place. It can be done, and I have every expectation that it will be done. It's just a matter of how quickly.
And Pavel, to that point, I want to refer you to a tweet from Elon Musk, because he was talking about short-term solutions while we have oil and gas. He said, realistically, I think we need to use oil and gas in the short term because otherwise civilization will crumble. What are your thoughts on that?
Well, nobody really disputes that point by Musk. I'm not sure who he's arguing with. 100 million barrels a day, that's a record, is the current level of global oil demand. And natural gas demand is also at record levels when we look at it worldwide. The lesson of the war and the European energy crisis is that too much dependence on any single energy source is or can at least be dangerous under certain circumstances. In Brazil, for example, there is too much hydroelectricity. Now, that's not a fossil fuel, but too much hydro in Brazil means that when there is a drought, which is pretty much every day now, the electric market in Brazil is disrupted. So in Europe, it's too much dependence on Russian gas. In China, it's too much dependence on coal. Diversification and having a balanced energy mix is the solution with a growing share of renewables, but nobody is suggesting that fossil fuels need to be given up tomorrow or next week.
And perhaps, Pavel, too fast a transition is what also Elon was warning about. And he wasn't necessarily talking about the United States in terms of production, but I do want to take it here. Are we doing enough for exploration and to boost production?
Oil companies all around the world, including in the US, have become more capital disciplined over the last 5 years. That means that despite, as you noted, oil close to $100 a barrel, there is less drilling activity than at the same price point 10 years ago. So the rig count is less than historically. This is not because of government. It is shareholder capitalism, pure and simple. Investors have told these companies, drill less, invest less, instead pay more dividends and do more share buyback. And management teams have responded and internalized those criticisms. Now, the side effect of that is prices will be higher for longer. If shareholders go to the management teams and say, oh, okay, we changed our mind, go ahead and drill as much as you want, then companies will go back to that approach. But as long as the investment community pressures oil and gas companies to be very careful and disciplined with capital allocation, that's what they will continue to do, regardless of what politicians might want.
Well, a great conversation. We'll have to leave it there. Big thank you, Pavel Molchanov of Raymond James. Thank you for joining us this afternoon.